Welcome to Fundamentals for Startups, a Commotion Labs production. My name is Siri Vimonchalau. I am the Commotion Labs Hardware Incubator Lab Manager, and I am your host for today. Commotion Labs is a multi-industry incubator hosting early-stage startups, both inside and outside the UW community. We are committed to nurturing early-stage startups, contributing to critical infrastructures, and providing opportunities for learning, networking, and mentoring. And we do this without taking any IP or equity. We have 3 incubators on campus, one of which is right here, Technology Incubator, and 2 others at Fluke Hall, which is the Hardware Incubator and the Life Science Incubator. If you are a startup founder looking for a community to grow, we would love to speak with you. Fundamentals for Startup is a regular lecture series open to anyone interested about entrepreneurship or about building a startup. Every week we bring in experts with diverse experience to inspire action, share insights, and answer questions. Note that all the Fundamentals for Startups presentations are archived on YouTube and on the CoMotion website. So if you're interested to see a presentation you did not get to watch, you can actually filter by topic. To register for future Fundamentals event, visit CoMotion Lab online and subscribe to our YouTube channel. Today, I'd like to introduce you to T. Potter, an investor who works with early stage tech and software company. She will fill us in on venture investing and how founders could approach early stage startups. Let's welcome T.
Hi, everyone. Thank you for being here. Always love being at Startup Hall. I hope everyone can hear me okay. So before we start today's presentation, just quick background about me in addition to what was just said. So before becoming a venture investor, I spent 8 years in building software products for gaming, for cloud. At that time, we didn't have multi-tenant, but it was still on the cloud. So after that, I also built my own business, a marketplace in India, and then came to the States for my MBA, focused myself in finance, went for investment banking in the Bay Area, and then decided to tie everything together and come in tech in the startup space again. And I work as an investor at Trilogy Equity Partners. Some of you may already know Trilogy Equity Partners is an early stage investing venture investment firm in the Pacific Northwest. We have been around for 17 years now. And our focus is on software companies in the region, C-stage, super early stage companies, building outstanding products with great founders. So with that, I want to kind of take a step back and say today's conversation is not only about venture. We have heard that so many times. What we are talking about today is how to think about the funding options for a business, where does venture come into play, and what else is out there, which is how do we align the interests of an investor of any kind to the business, to the duration, a lot of all these together. So moving ahead, it's not venture investor, it's like how do you find the right investor for your business. Now, even before we talk about what kind of funding is good for you, there are quite a lot of considerations go into building that flow chart. For example, like what are the key milestones? At what stage of the business are you in? Is it the ideation, the MVP, traction, pre-revenue, or revenue generating, or scalability phase? And then whichever stage you are in today, what needs to happen for the next 12 to 24 months for you to reach the target milestone that you want to be at your next phase? And then how do these milestones build up and align of the number of steps you're going to take towards the end goal of the business? And then that's when you take a step back and say, what are the resources I need to do it in that period of time that you have planned for yourself? All these things combine together to think about how much time do I need for before my next fundraise, what are the milestones, and then they also tie into, all right, if this is the time period, if this is the runway, a lot of times I hear questions about how much fundraising should I raise. I need 1 million, should I raise 3 million? I think this, at the end, is the runway conversation also keeps changing. We'll talk about later, is like, how does the market look like? How long sales cycles are, product cycles, a lot of things come into deciding, I need to raise for the next 12 to 24 months because I don't want to be on the road in 6 to 12 months raising again. It takes time and effort to raise, but also how long can I go with that amount I raise? So ton of questions frame the investment decision, and also that kind of goes to the second stage. Given upon what stage you're in, there's so many other options, like bootstrapping and friends and family might be good at a certain stage we'll talk about next. There's strategic angels, grants, and then venture capital is one of the options, not the only option. And then there is like AR-based financing, incubators and accelerators like Techstars, and other debt instruments as well. So that ties into, as I just mentioned, how much do I need to raise before I start fundraising again? And then once all these milestones or estimated numbers have taken shape, then comes, okay, who is the right investor for me? Now, is my business aligned with the investor's focus and values? We'll talk about what venture scalability means. What do I need from investors just outside the funding or the dollar value? And does the investor, especially true for early stage companies, does the investor have the expertise or the network that my business needs? And that's super important. And one of the other considerations here is, okay, now you have a picture of why and what the fundraising needs to be. You have a picture of the right investment approaches. Terms of fundraising, like to understand what are the structuring and comparison of different kind of fundraising terms, what is standard versus what's more investor and founder friendly, which keeps changing based on macroeconomic conditions. Before I move on, I just want to make sure at any point of time, if there are any questions, please feel free to stop me. So now funding options by stage. These stages, the nomenclature is more venture, but let's talk about it from a non-venture point of view, and like, okay, pre-seed could be ideation, pre-MVP. Seed could be some kind of MVP traction. Series A is like you have the first revenue customers. Post-Series A is growth and scalability. There are multiple options to think about as you go through the different stages. And a lot of the discussions are like, when is it too early to talk to a certain kind of investors, institutional investors, whereas strategic investors could be really, really instrumental in the pre-seed stages when they believe, because they have the vertical expertise, they believe that what you're building is going to be, is going to have more value than an institutional investor who's more general would need more traction or more evidence of traction to be comfortable with the same business thesis. So these are some, we don't have to go through each of them, but kind of shows that there are multiple ways to approach. And of course, this is not an exhaustive list by any means. So this is my favorite slide, which I want to talk about. What is a venture scalable business? Now, even before we start talking about from the investor's point of view, from the founder's point of view, let's look at people who invest in venture funds. Like, what does it even mean, like an asset class? So if you look at the capital market line, given that we all keep hearing about yields are higher, treasury rates are doing better, private equity would be on the higher, high risk, high return. Venture capital even sits beyond that. So it's really high risk, high return. So when people are, even you and I are putting our money into asset classes, you'll be like, let's go through all of these and then go for venture, which the expectation is outsized returns, given the risk of it. So the reason I'm going through this is to understand at times with founders, one of the questions I hear is somebody has built a great business, a solid business, revenue, year-on-year growth is like 30% for 2 years, and like it's time for venture funding. That is absolutely stunning, and that could be a business, but for it to be a venture capital business, that year-on-year growth of 30% needs to go to a point, sustained number of years to a market where you can have like a, and we'll talk about that IPO considerations, like an exit where you're generating 100 to 400 million in revenue, which is just 2% of the market. That is what is more important than just the year-on-year growth, and that's what the power, law, and goals of a VC funds are.
Would you please just repeat that sentence, or those two sentences?
Which one?
I understand your point, but you just gave a detail, something about it's you don't just want. Oh. Hi.
Yeah.
You just said something interesting a couple sentences ago about what you want outsized returns, right?
Venture as an asset class, the probability theory of a portfolio construction is, the assumption is the power law, 2 out of 10 investments will make for the whole 10. So venture investors invest in that thinking that given that 8 of them will fail, 2 of them will make the whole portfolio work. And that's why they take such a huge risk in the beginning when there's no revenue, there's some traction, there's a lot of belief in the founders they put in, but that also comes with a very known risk that 8 of them are going to fail. But how, as an asset class, you think that if you have to give such a high risk, high return, there's 2 companies that become the stars of not even a fund, but an area, a region. You'll have success stories about them. How do they provide that kind of returns? And that is what, as an asset class, are. So why is that important? A fund raises money from LPs, they have to go back and raise again. If the fund does not stick to the thesis, which we'll talk about again, and the outsized return expectations, it's going to not be able to raise again, and that's harmful for a venture as an asset class altogether. You'll hear now when the market conditions were not that great for Web3 and all the good things, there were so many articles about ventures and asset class is worse than private equity, and people stopped investing in it. That's harmful for the whole ecosystem altogether. So we're talking at a very high level of like as a capital market, and then we'll come down to what an investor thinks. And that's the whole talk about there's growth, but there needs to be a massive market opportunity in which there are enough number of people who are willing to spend that money to buy the product. It could be a niche, but also depends upon how big the market is. And if it's a winner takes it all, if it's a fragmented one, all these play into what the scale that the company will reach at. And then the third part is scalable, repeatable revenue, which pretty much means you have a solid and that's why venture is so much into software or tech, right? You don't have to put a lot of capex, but you can scale with variable cost, variable revenue. You put in the software, you just get it deployed. You don't have to add more people. You don't have to throw more headcount, but you can scale to more customers, repeatable, recurring revenue. And the last point, again, super important. All of these stories or all of these achievements and milestones are contained within the expectations of the fund life that you raise from. I mean, of course, it's 10 years, it's anyways long, but what if it takes 15 years to build a company? Who knows? But after 10 years, you will kind of, as you bring more stakeholders into your board, everyone will have different expectations. You might have 2 different investors thinking like, one of the investors want returns in the next 2 years, the other one has more flexibility to wait for like 6 years because their funds are at different stages, right? Or maybe that investor wants to exit and do something else and they want their own part. I mean, it's alignment of your expectations, your duration with the investor's expectation duration, which at times causes some kind of misfit or a misunderstanding of the venture investors or investment as a class. Coming back to more detailed about what each of these mean is the scale. What if this works? If it doesn't work, venture equity goes to 0. Equity holders get nothing. But is there an opportunity to return 20x? Can this become from a 10 million company to a $1 billion company? And some of the stats I can give you again, the median, or I would say the ballpoint figure of a revenue of a company at IPO. Not every company has to be IPO, but even if that one company in a portfolio, if they have to go, and you start with the assumption that every company is going to be a rock star, right? Is at least 100 to 400 million at IPO. So there are some companies that have gone 90 million. For example, Klaviyo at revenue at IPO was 585 million at a revenue growth of 56% and 119% revenue retention. Those are huge milestones to achieve. And as the macroeconomic conditions change, what happens is you could see some companies back in 2020 to 2022, when I did 3 IPOs at the same time, was you could be a cash burning company with good revenue, but maybe a path to profitability in 5 years, and you still could get like multiples of revenue of 3 to 4x to today, where Instacart, Klaviyo, all the other IPOs you have seen that have barely made it to market with down rounds or even flat rounds compared to the last round are all profitable. They've achieved profitability as of June 2023, and they're still getting the same multiples or maybe lower than what was there before. Klaviyo was at a 12x revenue, and Instacart was at a 3 point something x revenue. So it changes based on, again, at the end, an IPO is public market and public investors. Anyway, so thinking about where the business may reach is something that a venture investor will always think about. What happens in the next 5 to 10 years? Is the TAM big enough? Is there enough advantage that the founder has to tap this market? Like, why will this team build something and someone else cannot come in and just sweep it out and take their market share? And risk, not only in terms of the investors, the founders take massive risks. How long can they continue to take this risk and continue for 10 years or more than that to build something which is going to be a huge success in terms of size? Any questions here? Go ahead.
For the TAM, on the point of the TAM, sometimes our concepts will be in markets that may not be very big right now, but as a company we're trying to hope that the TAM itself becomes big.
Yeah.
How do you, as an investor, look at that? Do you try and forecast the growth of the market itself and not just the company?
Yes, always forecast the scope of the market to the extent you can. So that you also lead to a very interesting segue. At times there are companies that are built that are so novel. We think about it as like, is this an urgent problem that people are looking at solution today? Or is this a problem but no one's looking at a solution? Which means if you have a product, people are ready to jump into it and say, I'm going to pay for it if it works for me. I'm going to sign up for a pilot. On the other hand, there's another option where companies would be like, you have to create the market, create the awareness to be able to sell into the market, which is perfectly fine at times. Also, they say the first mover disadvantage, right? But what happens when maybe, I'm talking about not all investors, but time-bound venture investors will think, and even like many others would be the same, is this going to happen in my lifetime? Is this going to happen in the fund's lifetime? If it does, maybe we invest 5 years down the line when the market is ready to use this product. So to your point, the market may not be there. The disruptors never have the markets defined, but if you can predict based on the traction today, how many more can pick it up, that's why we talk about traction. We'll talk about it later at the end. That gives a sign, a signal of what the market is looking for, and also gives the idea of a duration of, if you have more such customers, what is the duration from POC to ARR based subscription based on the value you're adding? So the market is the market now or is the market tomorrow is another question we look at. Any other questions on this? All right. So now we come to finding the right venture investor. Now that we have discussed what venture means, is the first part we have already covered in one of the oldest slides. Like, based on the stage, you have different kind of investors come in. Usually seed is a place where you'll have most institutional investor come in, and then Series A is almost, let's even take a step back and talk about these stages. So pre-seed, as I mentioned, MVP, ideation, moving to completion of the MVP or closed beta. Seed is you have an open beta or launch product or a couple of POCs running with design partners with the intention of becoming paying customers. Series A is a point where you're almost trying to reach product market fit, because seed is not there yet. You're testing product market fit. By Series A or at the end of Series, you're almost like, this is what I think the market needs. You have reached a saturation of like building the wholesome product. And then as you move towards Series A, to the growth stage, which is post Series A, you're thinking about scalability only. Product market fit has been established. You're thinking about, okay, how do I scale this from like a 5,000 users to like 5 million users? And then comes finding the right investor is thesis and portfolio construction, something we just spoke about, but we'll dive a little bit more deeper. Investment thesis of the venture fund. What does it even mean? Like, you can go to an investor can find an excellent company and they were like, this is a solid business again, but cannot invest in it because it just doesn't fit the investment thesis. It is important because at the end, when they went fundraising from the LPs, they said, this is exactly within the framework where we will invest in. And every time they make an investment, there would be of course, if there's an outstanding opportunity in the boundaries of that thesis, they will go for it. But usually the idea is to stay within it so that the LPs don't get uncomfortable about, like, are you even sticking to what you said? This is why we invested in. For example, if someone is an ESG investor, someone is more like invest in diversity, they come up with, or maybe even smart cities, they have to invest within the boundaries of that. And that comes to like what the couple of more things to think about is like, do they do just the initial round or do they have buffer for your follow-ons? This is especially important for lead investors who write the bigger checks to see if you need a bridge, which is a situation right now. Most founders are raising bridge rounds. Would that investor come in and is that a part of the thesis to do follow-on, or the thesis like we just do the first round and then that's it? And the size of the fund is important, and the stage they invest in. I mean, I cannot stress how important it is to focus on the stage of fund, because a lot of times, like, you can go to a Series A investor and say, hey, we're just in the MVP process. Like, did you just even check my website of what I invest in? That is the first thing. Like, just check the stage, if they lead or not, and then you can go and ask them all the good questions about. And this is something every investor should even answer themselves, like, this is what we do, this is our check sizes, this is the kind of companies we invest in, and it's completely okay to talk about that with investors. Vertical expertise. Two is think about it. At the end, when an early stage company will take the money, they will also need network. They also get introduced to customers via the investors, their portfolio companies who they want to sell to. And they also make very important hiring decisions based on the network of the investment fund. It could be one, could be multiple, but it is important to get a VC who has had some experience in this area. And let's take two examples, a real estate SaaS company and an education AI SaaS company. The kind of investor they could be looking for is a B2B SaaS company that knows how to sell to enterprise, but also a strategic investor, maybe writing a smaller check, that is in the education space to make those connections, or maybe draw expertise or draw talent from. A real estate B2B SaaS company could think the same, like get a lead investor who is a B2B SaaS, but also someone whose focus is investing in real estate, maybe tech, maybe not tech, but a strategic investor. And those things come to play when you need to make so many multiple decisions in your business in the given industry. And then, as I think it touched upon, the network and the vertical expertise kind of tie into each other. And the long term is, what is the fund duration? Like, how long? Everyone thinks that they'll need 8 years, 10 years. When I was running a business, I thought I'm going to do it in 2 years, and then completely misunderstood cash flows, inventory, capital management. It never goes according to plan, right? So how do you make sure at least the larger lead investors you're going with, they have the time horizon to be supportive for long term, especially for early stage where you might need a little bit longer to improve your product market fit? How do you get someone who's patient enough? Okay, any questions still here? Go for it.
On the last point, on the last point, is there any consideration as a founder we should have on how long the fund that we're trying to get invested by has been around? So, like round one of investor X, this is, they're about to raise their second round. Are they expecting a faster return on the last few investments of a particular round?
So at times that could be a consideration for certain funds, of course, if they have very strict. I would say if depends upon the LPs in the fund. If they raised from a very diverse set of LPs who want strict returns at a certain point of time, yes. One way to achieve that, to understand how long do they hold, is look at their portfolio, look at when those companies have been invested in, and if they still have an exit story, if they're not, if they're still supporting them. Kind of tells you a track record of how long they're okay to hold their investments. Do they push for exits? Do we like, nope, you do you, and we'll figure it out with you as you go. So it is a huge spread depending upon the kind of venture fund you're talking to. But doing that diligence is important to see, even if they're a new fund, there's no record there, but you can ask them, like, how long do you think you're looking at investment returns? It's more like a soft thing. You may or may not get an understanding, but if you have, understanding that could be. Also, another great point is, as investors do diligence on you, founders do diligence on investors. You can ask them, I want to talk to 2 founders you've invested in, and just like understand what they feel, and you can make that as like a new founder and a very old founder and kind of gauge that. Multiple ways to find that out. Any more questions on this? All right. So we spoke about what a venture scalable business is. We are going to move towards a general understanding of the market. I mean, it has changed so much from the last few quarters. So early stage funding. Now, this is as of Q1 2023, but you'll see that these are the median and average for seed rounds and the median and average for Series A rounds, which is, I mean, even if 2021 and 2020 were outliers, you can always see it has dipped a bit from 3.7 to 3.6, and even I'm sure Q1 and Q2 and Q3 would be a little bit more different, but it hasn't, it's still holding steady. So good companies that, not good companies, companies that immediately meet the criteria of a solid investments are getting invested. There is still the same amount of conviction that's out there, but the next slide will show you the number of companies that is being invested in has decreased. So pre-seed and seed deal activity by quarter, if you see as of the latest quarter, Q3, this is based on PitchBook, the deal activity has come down, and it's kind of comparable to 12 quarters before. This is, you can look at it in 2 ways. 2021, starting like June, so 2022 was an outlier. If you take that portion out, I don't think it's a drastic change. Of course, it's more flat than down, but that was a different time when capital markets were on fire. Everyone was deploying capital in public markets, and thus, as you have more companies going to public markets, investors get their money back, and then more gets deployed into private markets. So it's just like that virtuous cycle. So deals are still being made. The median and average deal rounds are not high, but again, flat to minor low. But the number of deals happening has decreased. And the reason being, think of it as a pipeline. Like seed has to go to Series A, Series A has to go to later stage, and then there has to be an exit and then come back and recycling capital, right? In this case, especially in Series A hurdle, what's happening is your sales cycles are becoming longer. There's more audit and software. People are actually going back and seeing if that 2 software overlap in a region, like both of them provide the same thing. Do I really need this other software for that incremental benefit it gives me? Not only that, it's getting harder to convert, not harder, it just takes longer to convert POCs to subscribers, which also comes back to the conversation we had, is like, how much runway do you really need? And it's the same as we needed in 2021. And then this is also gone into another part where maybe you could raise a Series A at 1 million ARR, which could even be a possibility today. But now everyone just needs a little bit more evidence of that success story. So they will be like, oh, 1 million is great. What's the path to 2 million ARR? So the AR expectations have also shifted for investors at the point where would they want to come in and invest in a Series A or later stages. Yeah.
This is U.S. market
Yes.
across all sectors?
Yes, U.S. market across all sectors, not tech only. All right. Sorry, go ahead.
So, just going back to the seed, pre-seed. So, is that going to keep going down? I'm worried that so much of this fund that was deployed in 2022, it's going to reach maturity, and they were overinvested, and now these funds aren't going to return. All of a sudden, what may have been flat in the future, predicting may not be. Do you think that's a probability, or?
So, without speculating the future, my 2 cents would be, you're right, like there is going to be a definite markdown on portfolios of certain investments that were made in between 2021, mid-2021 to end of 2022, and that people are already making discounts on that. It's not going to change. However, there is dry powder. There are more funds raising capitals from LP. So I think the correlation between dry powder and investable assets is just that people are looking for high quality assets. The return of capital for that specific fund could be, but then there is more funds looking to invest in new assets. So I don't see this going down drastically. It's still going to continue maybe. I don't know. I cannot speculate the market, but there is evidence of dry powder out there. But is it getting deployed fast enough? No. Investors are holding it, saying, well, do I really want to deploy it? I'm okay to hold on it. As till the point I feel, if I put it here, this is not going to be a sunk cost. So there is capital, to your point. Like there is capital to be deployed even if there's markdown of portfolios, but it's slower to get deployed. It's taking longer to get the conviction.
One quick follow-up, is how dependent is this on what environment you are? Like are you in AI? Are you in something else? Have you seen the trends there? Because obviously a lot of people right now investing in AI, but if you're outside of that, does this graph look completely different?
Good question. So okay, going to that, the way I can tell you the way we look at it. I cannot speak for the whole venture community because there is not enough data. I mean, there is a graph where it says amount of dollars invested in the whole startup ecosystem, number of dollars invested in AI, but also within that, most of the dollars are being invested in AI application. There is more investment that can go into AI infrastructure. So that is definitely, it's a new industry. Coming back to TAM, the TAM of AI has not been defined yet. It is still a market that is waiting to be captured. It's not saturated. So it does make sense for investors to come in and say, hey, not applications that use a chatbot, but like founders building infrastructure for the new application that need to build on AI is something which we do see, and I personally see as a growing focus. But that is to speak that this market is waiting to be captured. That doesn't mean that other investments are not getting funded. One of the theses also there that selling to traditional companies and how can you draw efficiencies of them using tools that large language models can provide, which wasn't possible before. So I would say Gen AI is, the reason I hesitate at times, Gen AI is used at such a huge top level, like everything's Gen AI. But at the end, every portfolio company, if you're not using it and if it can be used in a business, people will fall behind. But if you're using it, you're not a multi-billion-dollar company. So they're very different, and we can have a whole 1-hour discussion of like, what does even that mean, large language models? It's an enabler to create efficiencies. And I will not diverge, it is getting more interest from investors because it's not a saturated TAM. It's an open grab all. We don't have data on that in this. Does it answer your question? Very long-winded answer? Okay, all right. What are investors curious about? I'm not going to talk about every investor in the world, but this is my take on what makes more sense. So this is the general framework of how one can think about the pitch framework. Now, these are by no means the 11 slides that anyone should have. No, these are questions that may be answered in a sentence, but somehow the flow chart of thinking, and starting with the pain point, and to point like Gen AI. If someone comes and tells us, I'm building a Gen AI, et cetera, we're like, wait, hold back, go back. What is the problem you're solving? What's the use case? Why? What is the solution? Why is this important today? So that's where we start, not how. Gen AI is more the how. What's the pain point? What is the impact of this problem? Is there a dollar impact, or is it just like good to have? And how many customers face this problem, which kind of goes into the understanding of the market. Once that hasn't been established, the next step is like, all right, even before the world had your solution, what were people doing? Did they have no solution at all and they just did it manually? Is it a greenfield, or is there such an old legacy system that needs to be replaced because it's anyways not doing the job? And now tying that to your product, like how are you solving this? Why are you solving this today? And a lot of the times we are seeing this, especially as I talk about LLM infrastructure, everyone's solving a problem. The problem exists, but it has not been defined. Is this the standard way of solution? Like, is this going to be the solution? Or maybe there are 5 different ways of doing it and we don't know which one is going to be the right solution. So trying to understand why is this the right solution, which also comes to product market fit. And investors need evidence from founders, but they also need evidence from the market to understand that this is the solution that they're looking for. And what is the advantage of this team? Like, how is the problem tied to you so that you have felt the pain? Or do you have the vertical expertise to sell into the distribution channels? Or you may be so well versed with the tech that you can apply it to any workflow. There has to be something that ties this problem or the solution with the founder and closely. I can give an example, like you can have a board of advisors who are helpful in a certain field, but if you're creating a medical product or maybe a solution, a B2C solution for a pharma, you need to have someone on the team that understands that flow. You cannot go to advisors. They are not in the room deciding product pipeline with you every time. So that is important. You cannot have advisors do that for you, for the core proposition. The target market. I think we have spoken so much about the market, but I cannot stress how important it is. Like, who is your ICP? Who are you going to be selling to into that organization? Or who is that person who's going to download your app and use your app? Is it a rip and replace, taking out a competitor and putting a product in? How strong is that competitor? Even if it's a legacy product, what is that switching cost that people will go through? Or are you coming in with the wedge and then you're going to expand it? And then, is it greenfield? And the greenfield question, again, has 2 ways. Is the market aware they need to use a solution, or they know that they need to and they're going to, there's an urgency of you selling to them and they'll use it. Business model, again. How will the business make money? What are the unit economics? It becomes even more important now as we have gone from a growth at all costs to, not we, the market. Some investors always had some thesis, but the market has gone from growth at all costs to more sustainable growth. So bottom line in the future matters. So is this aligned with the ROI or willingness to pay of the customer? How do you even find out what is the willingness of the customer to pay? So one thing I tell founders is, if you can find out the problem, the impact of the problem, and then find out how much it costs them, and you take a piece of the pie, that's a good way because it's a win-win situation. Traction is we'll talk about in the next slide in more depth, but it's also like customers, pilot, pipeline look like, but not someone. It's with the intention of someone being a paid customer. It cannot be friends and family using a product. The competitive landscape, again, cannot stress how important it is. There may be no established players, but at the same time, multiple people are building solutions. So for founders, at times, do a benchmark on where they differentiate themselves, why they will be successful in a pool of more people doing it. Always helps investors kind of like, okay, this is a great solution, and I believe why this team will be the one to kind of achieve success. Go-to-market is this is also a huge area of discussion, but to think about go-to-market in terms of like, what are the channels? How do you tap in the channels? And what is, again, your advantage of making sure that you can leverage the vertical that you're going to sell to, and what's your way into that? Team, credentials, and at the end, the ask. It's self-explanatory. We don't need to go talk about that, but the use of proceeds ties to like, where do you want to be based on the fundraising expectations you have today? What is that expected runway, and what do you need to be there? So, any questions on this one? This is the last content slide here, which I feel is so important to discuss about traction, because I do hear, what does traction look like? Definitely there's revenue, but when early seed investing comes in, seed investing comes in, a lot of companies don't have revenue, and we don't need revenue, but we do need traction. Traction is a measurement of product market fit. It is to go back to the same question when it says, why is this solution the right solution, and why not any other algorithm out there which is going to solve the same problem? So traction also shows, for example, increasing thing that we're saying is tech has become such a commodity today. The workflows matter. Workflow tailored to the person, the ICP you're selling to. So two solutions could be absolutely amazing tech-wise, or maybe one better than the other, but the one that is closest to the workflow without disrupting the existing style of work of the user could be the winner. And it's also a positive indicator of market interest. Examples, again, just out there for, this is again not an exhaustive list, but to understand like paid pilots with the commitment, or maybe even pilots with the commitment of converting to paid users, paid subscribers, annual subscribers with some like, with a ARR or the dollar amount in mind, is very powerful. For B2C software, not only the number of downloads is important, but also, okay, 1,000 people have downloaded, but how many people have actually logged in and created an account? How many people have actively engaged or maybe completed something based on what your product is? And what's the churn? Those numbers are more important, because that goes to say that at the end, when you go to your business model monetization, that remaining number of customers are your actual customers. So, especially true for B2C. And outside that, I would say a lot of customers directly a lot of companies directly jump into paid pilots without the expectation of an ARR, which is also fine, but any kind of paid usage is great. Any questions here? We'll also have some time for Q&A at the end. So, yeah.
MOU, what does that stand for?
Memorandum of Understanding. Yeah. So LOI and MOU are almost the same. They kind of differ a bit in the technicality and legal terms, but it's the intention of becoming a paid customer if the pilot goes successfully. All right. So we'll keep some time for Q&A. At the end, I just wanted to make sure that everyone has access to this, but I find this to be really useful. GeekFi recent fundings, it kind of gives you what kind of companies are getting funded. This is Pacific Northwest. When was it funded? What was the ballpoint amount based on public information? Who led the investment, which is great. So this can give you a more idea of what's happening in the Pacific Northwest ecosystem. And the links there. So this is it in terms of content. Any questions so far? I'm going to open it up to Q&A. I don't want to keep this, but this is my email on any kind of question and answers.
Thanks for the great talk. So what does the process of actually approaching a venture firm and trying to pitch and getting that ball rolling look like for a startup that's at the right phase for that?
Yeah. So there are many ways. There are times when you're ready to raise funding, but a lot of times people are like, it's nice to get to know a firm even before that you're raising funding. I would say being a part of different ecosystems like CoMotion, WTI, Techstars, they always have these investor office hours, investor speed dating. These are very nice low-key ways of like, hey, I want to talk to you, come under your radar, but I'm not raising investment yet. So that's a low-pressure way of engaging. And then I think events are great. Like a lot of these ecosystems here bring investors and founders together. So this is for someone who's not ready to raise funding yet but needs some more clarity, wants to be on the radar, founder circles. And then once you are close to maybe like I'm ready to pitch, I have a pitch deck ready, it's important to have a pitch deck ready. Not because of like, I know some people frown, some people are more conversation, that's okay too. Investors are context switching very, very quickly over the day, like 8 meetings. They just finish real estate and they're going to logistics tech and they're going to like some consumer software. Having a visual orientation helps. So once you're ready to pitch, I would say just emailing them, asking for introductions from anyone, especially in Pacific Northwest, people are very connected to each other. So if you can ask someone, I get it all the time, that even if I'm not the right investor for someone, they're like, you know what, can you introduce me to this X investor, which I am connected to, VCs are connected. And especially in this ecosystem, I feel everyone's extremely open to go for warm introductions. So that's the best way. You'll always get a call, you'll always get a meeting with them. And then the third step could be everyone has their website, you can submit it. I would say that's the last version if you don't get any kind of warm introductions. But events, incubators, warm introductions, even LinkedIn. Like just reach out and say, hey, this is what I'm building. Do you want to connect? And it's like, yeah, sure, for sure. Does it answer your question? Okay, all right. Office hours too. CoMotion has a great office hours. Okay, I'll come to you next.
Yeah, thanks, Dee. I had a question around VC a little more in general. It seems that there's a lot of incentive for venture capital in order for their business model to work, to look for companies that have that ability to concentrate an enormous amount of wealth into a few hands fairly quickly to get that 10, 20, 30x that you're looking for. And these days, a lot of companies are looking at organizing themselves around different principles. Instead of shareholder capitalism, more towards stakeholder capitalism. A lot of people trying to become B Corps. Many folks very much on ESG ideas. And I'm wondering, is it possible for a VC firm to construct an investment thesis that applies to companies like that aren't solely focused on their return?
So the question will also be like a structured portfolio that is not only focused on the return. Is that correct? Yeah, like more parameters. So what I also heard was like large amounts of capital in the hands of a few. In terms of early stage investors, I would say more than capital, it's also the incentive to deploy capital in such a risky investment that you know will go down is, I would say if you take venture capital out, there are more like venture debt comes with equity, but the equity holders take a big risk. So I do understand that there are some investors who go to LPs who have ESG, who have impact-driven, who have more diversity-driven investment thesis, and they not only care about the returns, but also the impact it's making. So at the end, it's LP expectation. The fund you go to, understanding what their LP expectation is, looking at the thesis, like tell me about the thesis of your fund. And that has absolutely correct these days. There are female founder venture startups. So that definitely exists. But the reason I brought together the market and the returns expectation is because of the financial incentives, the capital market. Like this is how, it's almost as if I tell my friends at times, if I had to invest my money, would I put it in an investment VC firm? I would definitely put $10,000 into an ESG fund. I was like, I love it. This is sunk cost, but I also want to make some kind of investment for my retirement, right? So I'll put $10,000 in a fund that does care about returns, and maybe I'll put some other in public market and some in. So at the end, talking about mathematically, I will diversify my portfolio to a fund that has some impact, but also some fund that gives me returns. Same comes from the VCs. A fund that is taking my money to make a return, they will invest in that way. A fund that's taking my money for an impact will invest in that way. So it's about finding the right fund. But I also feel at times that when people invest in stocks in public markets, they also are not everyone invests in like impact driven. Like when you say I'm going to invest in stock, you're not looking at. So it depends upon which fund you're targeting, and aligning your interest with the interest of the fund and in the interest of the LPs and what was used to get funds from the LP. And that's how the whole financial system is based on, right?
Maybe some family offices?
Yes, that's also there. Family office is a great option. Family offices, strategic angels, when someone invests their own capital into a company, they don't have the restriction or the constraint of like, they can stick to their own thesis, but they can also make outlier decisions more than a VC fund can, or not even VC, like PE funds. A lot of these, a collection of outside capital is more restrictive than a single person saying, I believe in this, I'm going to put my money, and I'm going to wait for 20 years. And that's completely fine. And that's why there's so many different versions of trying to get funding. And love it. Family offices too, yes.
Quick question. As far as you're preparing to raise, beyond a pitch deck, what are the most important things that you can have ready in advance to speed along the process? Let's say a venture capital is interested in due diligence process. Could you recommend what can you have to make sure you have all your ducks in a row before you start that process?
It's a good question. Especially for early stage, thinking about the first institutional capital, the diligence is very mix of art and science. We don't look at financial modeling. It does not mean, even if someone says we're going to have this AR in 5 years, we're like, we'll see. You don't even know what product market fit is, right? So it doesn't really hold a lot of value, but the value is tech diligence. If you're building a tech product, making sure you have a tech architecture, which is, I'm sure, will also be built when you're designing the product yourself, kind of. The first step would be, okay, I love this product, the market. If everything this founder said is right, I'm going to go to step 2. Let's do a deep dive on the tech, and then having those materials ready, whatever you need to explain. It doesn't even have to be an exact flowchart, but whatever you need to do that. And then going to, okay, you want to understand your pipeline. So having that clarity in pipeline is super important, because you said you have a couple of customers today, but the next question is go to market. What do you see it to be 6 to 12 months? It can change. But at this point, with the information you have today, what does that vision look like for 12 months? All these things are important, but that's not different from what you would do for a business in general. So I would say in that way, there's nothing different that you would, talking about incorporating a company and all, it's fine. You can do it when the investment comes in. Most founders do it once they have the first funding. They work with the council. VCs also have connections to different kind of legal advice. So you can connect them, it becomes easy. So I wouldn't say there's any extra work that needs to go before that. We have 8 more minutes. Any questions? Hi.
Could you talk about, for those of us who are maybe raising at kind of angel stage, some red flags that you might see on a cap table for you as a VC, and how we can avoid those at the early stage?
Trick question.
I like that question.
Trick question. Okay, I'm going to answer it from a founder's perspective. We want the cap table to be such that as you raise funding today, and you have to raise, if you look at Instacart, they went to like Series I would say. You need to do what you need to do till you reach the end goal. What we feel as not a disincentive is a founder getting so diluted in the early stages that by the time they raise their series A, B, C, D, E, they have no skin left in the game, and it's all investors own the company, and the founder is like, I'm checked out, I don't care. And however that translates to the numbers in the cap table, which you would understand, we want founders to have skin in the game till the end. So a lot of times when you see Series A happening, if the cap table is out of structure in which investors hold a chunk of it, new investors will come in and say, we want to restructure the capital table in a cap table in a way that investors get diluted, give some more to the founders to restructure it, because it just gets worse. And founders, doesn't matter how much energy you have today, 8 years down the line when you're hit with all the risk and returns of the long term, you will get into a fatigue. It comes in, and fatigue, no skin in the game, no return. There has to be more incentive to keep going. So that's the only thing we optimize for. Great question.
I'm just following on that question. I have found this to be kind of an interesting puzzle, and more or less I've come to the conclusion that I need to learn a lot more about managing that chessboard in order to figure out how to play well. Do you know of a book or a resource or something that would be that you'd recommend to people who are trying to prepare themselves to navigate that space?
In terms of like
The
capital
cap table
structuring,
and yeah.
I can definitely take a look. Like, I'm going to send it out later on. The reason is, me stating facts is great, but a lot of books come with opinions, and I want to make sure that when I suggest some materials, it's mostly stuck to facts and not opinions of the people writing the book. So there are definitely some books out there. Take everything with a pinch of salt, even what I'm saying with a pinch of salt. So I can take a look at it and send it out later on. Any last few questions?
You mentioned for VCs, like warm introductions help. How would you go about that with angel investors? Is there a different strategy to trying to find the right people for your company to get you to the next stage?
Introduction to angel investors for, I would say angel investors are looking for good companies and good companies are looking for angel investors. I would start off with trying to get into events or meetups organized, starting like any part, like this is the whole ecosystem. You can start anywhere in the periphery. Start with connections to a university CoMotion, or maybe any part of a university or incubator and accelerator, which is an event open for everyone, instead of going to a VC, because it's hard to find those angels, even for VCs at times, right? Once you have a connection to these open events, even if you're not part of the cohort, the idea of these incubators or community builders is like they get everyone, and then at the end, it's a matter of you meet one person, and from them you know 5 other people. It takes time, but I would say the first entry point, it is what I would do if I was a person who came to Seattle building a company, did not know anyone, make these channels through them. Also because the communities have they don't have like, I want to keep it for myself and not share it with everyone. They're open to sharing with everyone, and they're very generous about making connections. So starting there and then building up on each connection every time you ask them like, hey, what are the interesting events you go to? And they'll be able to tell you all the events out there in the world. I don't know if you are, especially about this ecosystem, there's a Startup Digest that Jacob from Techstars sends out, which is also a great place to see all the events happening. There's GeekWire events. So I think all those places are very good starting points.
Thank you.
Yeah.
One last question.
I can do one.
Okay.
So you had a nice slide on how to build a pitch deck. You had 10 points on there. The 11th was terms. And maybe you need all of that for a pre-seed or seed stage company. Does this change these 10 points, or is there more emphasis on certain points as you move to Series A and maybe bridge that people are looking for now?
Totally. This changes. This changes very much. This is for early stage only. For example, like you don't need to talk about your traction, or maybe, your competitive landscape will become very different. Your traction and go-to-market will become together, and it'll be like metrics. You're going to talk about how has your user cohort been, how has your retention been, who are the people ask about RFPs when you go to Series A. If you go for an RFP to a customer and they say yes, great. Who are those customers who are saying a no, and who are you losing to? So that becomes the next incumbent. So the questions change a lot for Series A, but some of the things remain still the same. Like the pain point would be established by then because you're already selling into the market. More people will start selling to the market, so it's not that nascent. Your advantage remains important. Competitive landscape remains important. But you will add more metrics to talk about how does your market performance today project to future market expansion, and that's when projections come in, because here the early stage no one talks about projections. but they will definitely talk about more financial diligence, assumptions in the projections, what needs to happen for these projections to reach where they are, the assumptions, and what will happen for them to not, so both like the base case and the good case and the bad case. So a lot of more additions come into this for sure. Good question. Yeah.
Great, thank you.
All right. Are we in time? Perfect. Thank you so much.
Well, thank you, T, for sharing your story with us, and to everyone joining us today. I'd like to bring the attention to also that today is National Mentoring Day. So it's a day to celebrate mentors and mentees. So find time to show your appreciation and thank your mentors. Also, see you next Friday at noon. Dana Robinson will present Craft a Compelling Investor-Focused Pitch. Sign up today to save your spot.